Welcome to the B.F. Anderson Technical Report for March the 1st. Speculation versus investment. Well, this is a quote from a book, a very good book called The Battle for Investment Survival. I think it's interesting to go back and study portfolio managers from the 1920s. Now, this book was written in 1935 by Gerald Loeb. Now, realize he's a portfolio manager, gets through the Great Depression, and survives. Now, there's some other people you can study. Jesse Livermore would be a real good study. Bernard Baruch was another interesting portfolio manager. However, a new one I've been looking at lately is about Alex Loomis. He was founder of the Loomis Funds. Interesting stuff. But I wanted to go over this quote with you real quick because it's very pertinent to where we are today. How much return can one make in the stock market? Trying to get a stated income from dividends, interest, or both, of 3, 4, or 5%, or whatever it is, really amuses me because of the simplicity of the point of view displayed. So, the going after a low return to Gerald Loeb, it amuses him, and there's a reason. It gets into the quote. Now, one thing he says in here that I'm going to get to the next section is he refers to the customer's man. Now, you have the customer, and then you have the customer's man. Now, back in the 20s, the customer's man was the broker, and he was a commissioned broker. So he was, I asked my wife the other day, I said, have you ever heard the term customer's man? And she said, no, I've never heard of it, but it kind of sounds like a butler or a servant. And I would say it sounds like a yes man. In other words, if you're on commission and you're selling things to the customer, you will tell that customer pretty much anything to get the commission. So he goes on to say, yet it is by all odds the more or less general point of view adopted by the majority, customer and customer's man, bond buyer and salesman, almost anyone in and out of the business. So in other words, this dividend thing, this low return current income thing is so ingrained in the system that everybody believes it. And I find, when I bring this subject up with people, they get very agitated about it because most people that I talk to like the concept of dividends. But I was listening to Warren Buffett the other day. Berkshire Hathaway does not pay a dividend. In the early days of Apple Computer, they did not pay a dividend. Microsoft did not pay a dividend. This is a sign that the company has passed its prime and is very successful, generating a lot of cash, but it's no longer it's no longer the company that it was when it started. Walmart did not pay a dividend in the early years. Anyway, he goes on to say, he says, there is no doubt that the average individual, seeing this point of view accepted without question, moves with the masses and adds his acceptance to the rest. So you can see it just continues on. Actually here, as in many other phases of life, the majority is decidedly wrong. In fact, the individual who does his own thinking must learn to question most mass movements of majority point of view, for they are usually wrong. Boy, this is really good stuff. It is for these reasons, and especially because I am personally completely convinced of the inevitability of loss when attempting to secure a safe income of small return, that I constantly suggest speculation rather than investment as the policy less apt to show a loss and more apt to show a profit. My feeling is that an intelligent program aimed at doubling one's money might at least succeed in retaining one's capital or actually making a good profit with it. Now, not everything you do is going to double. And I want to get back to the word speculation. Speculation it comes from the Latin word speculare, which is also the word deriving the word spectacle. So what speculation is, in its purest form means is that you're trying to see the future. You're trying to see the next wave, what's going to be the next big thing. So what I really think speculation is a more honest word than investment. So anyway, I want to get into what's going on right now with interest rates because this has to do with dividend paying stocks. Now realize here, interest rates peaked in 1982. I'm using the 10-year the 10-year U.S. Treasury yield peaked at 15.5% back in 1982, and interest rates have been dropping for approximately 35 years. Now, we hit a low here in 16 of about 1.3% and turned up. Now, realize that the last time this happened, well, interest rates hit a low in 1932 of about 2%. So that was the Great Depression, So what I'm trying to point out here is that interest rates are not dropping for just some crazy reason. They're dropping because economic activity is dropping. GDP growth rates are dropping. So basically for the last 35 years, the U.S. economy has not been inflating, it's been deflating. And we don't want hyperinflation, but the way we're going to have to get out of this debt problem we've got is we're probably going to have to inflate our way out of it. So the last time we got rates down to this level and then they turned up was 1945. So then we go from 1945 and we didn't peak until 1982. So you have to understand that these are very, very long cycles. And what I want to point out here is that, is this the end of an era? In other words, if you think about this, if the last time this happened was 1945, that's almost like a generational thing. So here we are for the first time since 1945, turning up from a low level, going to a higher level, and over time we're probably going to gradually climb back up again as we inflate ourselves out of our debt problem, just like in 1945 we had to inflate ourselves out of the debt caused by World War II. So as this applies to investing or speculation, for the last 35 years, dividend stocks, income-paying investments, things like that, bonds, so forth, have had a tailwind. Well, what if now we're turning and we're breaking the other way and they're now going to have a headwind? So we think that there's going to be relative pain and that investors who concentrate on these income strategies are going to find this very difficult, and I believe that there will be a shift from these types of strategies more into growth stocks. Now, what I did here is I took a period of time just to make a point. I took a period of time where interest rates rose, which was 1993, 94, then they rose again 1988, 1998, 2000. What was happening to things like electric utility stocks that pay dividends? Well, you can see. I mean, this is American Electric Power, peaked at around 27. Interest rates started rising, and you're basically losing half your money. So you might say, well, gee, I'm making this dividend, but then you're having a capital loss. So you're eliminating the total return, which is capital gains plus dividend. So, the greatest investments or speculations over the last 100 years did not pay these dividends. Now, on dividends also, you have to realize these are double taxed. So in other words, the corporation pays a corporate tax and they send the dividend out to the individual, and then the individual investor has to pay an individual tax. But also there's something else that a lot of people just don't realize, that this is no free lunch, because when a company pays a dividend, it reduces the book value of the company by the amount of the dividend. So in essence, you're getting your own money back. It's not like earning interest on a bond and earning interest on a CD. So what I did here too was I looked at a comparison for the period of 1995 to 2000, just like I did in the prior graph, using a comparison of American Electric Power versus the S&P 500. Now this is a ratio. When the ratio declines, the S&P is doing better and American Electric Power is doing worse. So here's how downtrends work. You're in the stock, it starts underperforming, you go, oh Lord, my portfolio is doing terrible, I've made a mistake, and then it rallies. Oh, okay, everything's okay, I'm all right. Well, then it goes back down again. Oh, Lord, my portfolio's doing poorly. Then it rallies. Oh, I'm fine, everything's fine. It's very, very, very deceptive. Now, if we take a look at another stock, same scenario. This is Entergy, which is our local utility. Same thing. You can see that during a period of rising interest rates, these are the types of stocks that are going to underperform, and it's going to be quite disappointing. Now, I wanted to look at even a current situation. This was a real hot deal over the last, say, 5-10 years. These are these energy pipelines. These are limited partnerships. These are partnerships that they have to pay out 90% of their income. It's all about just getting current income, the very thing that Loeb is trying to warn you against. Well, look at this. Look what's happening. It's happening now. We're starting to see the shift away from these types of strategies more towards growth strategies. So let's get into the top 5. Here's a new stock on the list. We do own this stock. I like the story. It's an interesting company called Grubhub. They are in the food delivery business. It's like an Uber, where they have a technology, a cloud-based platform where you can get on your iPhone or your cellular phone and order up food, and then it's delivered to your home. Here in town, we have a company called Waiter. Karen and I use it quite frequently. It's very convenient. As you can see, the stock is at and hitting new highs, doing quite well. This is another software platform, and I want you to notice the top 5 is mainly software platforms. These are companies that are benefiting from mobile technology. This is Match Group, which is a dating service. You can see it's continuing to do well. Hit a new high here recently, has kind of pulled back with the market. Netflix, another software platform, but this is movies. This is where you can rent movies over the internet, streaming. So you can see Netflix has been making new highs. Now here's a biotech, Sangamo Therapeutics. Again, you can see the uptrend. And then here's another software platform, a company called Twitter, which is acting quite well. So in conclusion, what I'm saying is things are changing. We are seeing a moment of time that you will probably never see again in your lifetime, where we're shifting from a deflationary type cycle more into an inflationary cycle for the first time since 1982, and this is very positive for growth stocks. So let me know if you have any questions. Thank you very much.